Good morning, everyone. Thank you for joining us for Armanino's webinar this morning, Streamline SOX with Cloud Accounting Software. My name is Michelle Maranakan. I will be your moderator for this morning's webinar. Before we get started, just a few notes about your webinar pane. You will see an arrow right there in front of you. Just go ahead and pull that arrow if you don't see the screen, and that will minimize or maximize your pane. Also, feel free to submit any questions that you have for our faculty. You have a questions box in your pane as well. And also, if you're going to be dialing in using your telephone, make sure that you have used telephone selected. If you are using your computer or laptop, feel free to select mic and speakers. Also, a few notes for those of you that are hoping to get California CE credit. We have a couple requirements that must be met. You must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. And we also ask that you complete the evaluation survey at the end of the webinar. And now for our presenters. Our first is Scott Schimberg. Scott has a mixture of industry experience where he has held positions as Assistant Controller, Controller, and VP of Finance. He became a Certified Management Accountant in 1995 and obtained his CPA certificate in 2002. Scott is a member of the Institute of Management Accountants, and Scott is a past president of IMA's Amador Valley chapter. Welcome, Scott.
Thank you for having me.
Our second presenter is Dave Davis. Dave has 36 years of experience, including in industry and consulting, including controller, CFO, and COO roles in Fortune 500 and middle market public companies. He focuses on SOX initiatives, technical accounting, SEC reporting, mergers and acquisitions, and temporary CFO assignments for clients. Welcome, Dave.
Thank you, Michelle.
All right, and I'm going to turn it over to Scott. He's going to walk us through our learning objectives.
Yeah, so today, as part of our CPE requirement, we need to just go through what the learning objectives are, and we'll cover a review of the SOX basics and a little bit around how we got into the whole SOX environment to begin with. We'll then go into some tips around applying the SOX readiness, and then we'll also get into some interpret some of the processes around payables, controls, and getting the audit evidence that you would need around a payable cycle. And then we'll also bring in the whole concept around cloud accounting and how that comes into play. And the cloud is really the cloud ERP solutions. And so today we'll go through and bring up a bit of the history. We will cover the SOX landscape. We'll get into the cloud computing in SOX, and then we'll talk about that case study within the payable cycle. So, Dave.
Thank you, Scott. I just want to preface my discussion this morning with I'm suffering from some laryngitis. My voice is better today than it was yesterday, but it still sounds like I've been smoking cigars for 60 years or something. And I'm not that old, but it does sound that way. So I apologize if my voice is a little breaky and scratchy. First, let's take a couple of minutes to talk a little bit about IPOs, because this is setting the stage for SOX compliance. As we live in Northern California, IPOs are a fact of the world here. And all of the companies that go through an IPO have to then, at some point, become SOX compliant. So we thought it'd be good to give a little history on what has been happening in the area of IPOs. Last year, we had about $51.7 billion in capital raised, and there were 145 deals, and that's in the U.S., not just Northern California. A lot of those were here, but that's across the U.S. And you can see from the chart, we have history going back to 2002, courtesy of Red Herring and Renaissance Capital Studies. We accumulated this information from there. So you can see the number of deals is not near its peak from the 2004 to 2007 timeframe, but it's significantly up from 2008 and 2009. So that's a lot of new companies that have to be in compliance with SOX at some point. And you know, that's the reason for this. And a lot of these companies are using cloud solutions nowadays for their accounting systems. And so that's why we're linking the IPOs and SOX with the cloud solutions. We go to the next slide. There's really a couple of things we got to keep in mind. Due to the Jobs Act, which gave relief to newly listed emerging growth companies related to SOX compliance, most companies are procrastinating nowadays when it comes to SOX compliance initiatives. This actually is a mistake, as it's been shown that SOX compliance initiatives can drive important improvements in processes and, more importantly, improvements in the control environment of the newly public companies and help them avoid things like material weaknesses. But let's face it, in the rush to go public, most companies do not take the time to refine their processes related to accounting, or for that matter, operations. But once public, they need to focus on these things as the standards of being a public company continue to escalate year after year. It's a bit concerning, and there have been studies that show that the most successful post-IPO companies operating under public company rules for at least 12 months, or I should say operated under public company rules for 12 months before they went public. By doing that, they ingrained in the approach of the people and in the mindset of the people how to act and how to run a public company. So setting the stage by and for the IPO by getting in SOX compliance is actually a good thing to think about. So how do we set our priorities? Well, this really ties back to Armanino's CFO Evolution Survey that we do on an annual basis. One of the 7 key directives that came out of that study last year was that you should focus, companies are focusing on what they do good and outsourcing in other areas to gain expertise and knowledge they need to complete those things. And SOX compliance is one of those things that gets outsourced on a regular basis.
So Dave, a little bit on top of that, coming from the cloud or implementing cloud-related products, is really touching on 2 things. One is getting a good business process in place and a good system in place well in advance of making that march towards going into being a public company. But then also offloading that infrastructure setup, and we'll talk a little bit more about what that means, but not having to worry about as much of a heavy IT infrastructure within their environment. So it's kind of an interesting concept of how that SOX can help focus companies on what they're doing and what they do best.
I agree with that, Scott. As you decide to use cloud-based solutions, you do remove a lot of the IT infrastructure and IT controls that are required to be in place when you have on-premise software solutions, especially since the cloud-based solution providers all have SOC reports that can be relied upon to evaluate, that the company evaluates for compliance. So I think that's a good point to make.
Great. All right, so part of our CPE, we get polling questions.
Just a second, you'll see it on your screen. Sarbanes-Oxley was passed by Congress in 2004 in response to what issue? Insider trading, corporate accounting, Whitewater, Bountygate, or are you not sure? Please take a minute to make your selection. All right, and it looks like we have just about 90% of our audience that has voted, so thank you very much. We're going to go ahead and close the poll and take a look at the results.
All right, so the answer is corporate accounting is the correct answer for that. And it was really to address to a couple of key debacles that happen in the accounting industry we'll cover here in just a minute.
We go to the next slide. So picking up on that point, there are 4 logos on the screen that I'm sure all of you understand what happened at each one of those, be it WorldCom processing small transactions that were fraudulent that got under the radar, or Enron that just blatantly hid stuff off their balance sheet in special purpose entities and said, no, we don't have to consolidate those. And some of the others, Delphi and Tyco, had various other accounting irregularities, let's call them. So Congress passed in 2002 the Sarbanes-Oxley Act, and it has led to the formation of the Public Company Accounting Oversight Board as part of that, which is now the regulator of the accounting professions. So the accounting profession is now a regulated industry. So obviously what you can think about when you think about regulated industries is costs are going to go up because there's going to be more compliance work to be done. So some of the key provisions of the law that impact the finance organization, Section 302, which is the quarterly certification by the CEO and the CFO that they have proper controls in place and disclosures are appropriate. Section 404, which is the biggie, which is the assessment of internal controls on an annual basis, again requires certification by the CFO and CEO that they have a process in place, they have tested the controls, and that they're effective. And Section 906 is the one we never, ever want to hear about because it's the criminal penalties. So what the law did was take and provide criminal penalties for non-compliance with Section 302 and 404, which made it a lot more onerous for people. I really wouldn't want to be wearing those orange jumpsuits they have in California here. And then Section 1107, which is criminal penalties for retaliation against whistleblowers. Because as Sarbanes-Oxley required, every company has to have a whistleblower hotline set up as part of their corporate governance. And whistleblowers cannot be retaliated against, so that encouraged people to blow the whistle and bring to light irregularities that might be perpetrated out there in the marketplace. So Section 404 and 302 are the ones that have had the greatest impact on business since it established the requirements for internal control over the financial reporting. The other ones are the areas we want to stay away from. Okay, thank you, Michelle. Next one. So, excuse me. Let's take a look at SOX compliance process in 3 simple steps. First, we have readiness. And this is the phase of the process where we document all of our processes that have an impact on financial reporting. We identify which controls within those processes provide and address the risks that are inherent in those processes that could cause misstatement of the financial statements. Then we drop down into risk and control matrices. So once we've identified the risks, we have a series of evaluation of those controls as to what risks they mitigate, what type of control it is, manual or automated, what financial statement assertions they relate to. Is it a fraud control or not? Because fraud is a important aspect of SOX compliance, or I should say mitigating fraud. What reports and systems are used within those controls and what information is pertinent to that control execution. Those are all the things that are identified, and evaluated as part of developing the risk and control matrices. And then from there, you evaluate whether or not you have an appropriate control framework in place and have mitigated all the risks that are inherent in your business related to financial reporting. The next phase after that is the effectiveness testing. This is the phase where you have to develop which controls are you going to test, how are you going to test them, develop the test scripts and the evidence that you're going to be looking for, and pull it all together and evaluate whether or not the controls have been executed appropriately. Summarize all of the results in a memo that documents what your process was so that third parties like your external auditors can understand what you did as a company to get ready and test your control environment. And then if you have identified deficiencies, you have to evaluate them. Management has to go through a deficiency analysis, determine whether or not those controls separately, individually, any exceptions that you identified were a material weakness, a significant deficiency, or just a control deficiency. And then you have to evaluate whether or not in conjunction with each other or in interplay with each other, they gave rise to a material weakness. Say, for instance, you have 5 different controls in a particular cycle, and 3 of them have a deficiency that is noted. Individually, they may just be deficiencies, but as a whole, since they are all related to the same process cycle, that may be a significant deficiency around the design and the execution of those controls. So that's where management has to use their judgment to evaluate those. And then the last part, management assertion. Management is responsible for reviewing all of the documentation, the testing results, and the effectiveness of that testing, and determine whether or not they have an effective control environment in place before they sign the certifications in the 10K. So one more point is, if you have a material weakness after you've done your evaluation, you have to report that publicly in your 10K. If it's a significant deficiency or several significant deficiencies, those get reported internally to your audit committee. And at the end of the day, control deficiencies do not have to be reported. But as a general practice, most companies are informing their audit committees of all the deficiencies that have been identified and how they evaluated them, simply to keep the audit committee informed of how the SOX compliance initiative and program has been effectively executed.
Hey, Dave, before we go off onto the polling question, just two questions. Maybe if we can go back to that slide. On the SOX process, where does this remain and what goes away? So we talked a little bit about just getting ready and being compliant. How much of this actually goes away once you are a public company and you've been in the process for a year or two down the road?
Well, what goes away is the heavy lifting in the readiness process. So each year you have to reevaluate your documentation for changes in your accounting processes, your business processes that could potentially impact your financial reporting. So you do have to evaluate and update that every year, but you don't have to start from scratch.
Right.
If you implement new systems, you have to go back and evaluate, are the controls we have in place sufficient for the new system? Should they be changed for the new system, etc.? So that heavy lifting is not as significant after the first year. The testing phase doesn't go away ever. You have to do that every year. You have to do it to the same extent that you did it the first time, the second year, and the third year. In theory, as a company gets more comfortable with its controls, it should be a little more efficient to do that test work because they'll have the evidence, they'll know what they're looking for, they'll know how to document it. the people executing the controls so that the testing may be a little more efficient. But it seems every year the PCAOB comes up with some new thoughts and regulations on what they're concerned about, and the level of documentation keeps increasing over time. So you get some offsetting benefits and additional work each year.
Yeah, and on the ERP portion of it, particularly as we're deploying the solutions, we're seeing companies want to really get ahead of the curve, and before they need to do the readiness part around SOX, really deploy their ERP system and get that set up so that they then could do the documentation about their existing systems that will go forward. We don't see a lot of companies that go public and then switch out systems shortly thereafter.
Yeah, my advice to companies going public is get that system in place that you want to run with for the first couple of years you're a public company, because number one, the cost of switching systems is extensive at times, and the workload on the people. And if you've already got your control environment in place, you have to make changes to it. It's a lot of work. So you're better off doing that ahead of time.
Yeah. And from that readiness piece, how long in advance are you seeing companies really wanting to start that readiness piece? We talked about 12 months of a good practice, of kind of trial runs of being in that place. So how far ahead are we really looking at having all this set up in terms of a IPO time period?
We suggest to people that they start the process anywhere from 18 to 24 months before they're going to go public, or they plan to go public. That will give them that 12-month runway. And it depends on how complicated they are, how big they are, as to whether or not the 24 or the 18 months is the right time period to go, but somewhere in that range.
So a little combination of their complexity and size will dictate how far in advance you'd recommend.
Yes.
Okay. Super. All right, some more CPE activity.
All right, this is our second polling question. SOX Section 404 requires CEO and CFO certifications of control effectiveness at what interval? Monthly, quarterly, annually, never, or not sure? And just a reminder for those of you who wish to get CPE, you have to respond to at least 75% of the polling questions throughout our webinar. All right, it looks like we have just over 90% who responded, so we're going to go ahead and close the poll and take a look at the results.
Yeah, not surprised by the answer, because it's unless you're really in it and do what I call living the dream, it could easily be confused between whether it's quarterly or annually. But 404 is annually, and 302 is the quarterly sign-off that comes into play. So the answer is annually.
All right, so what's next for SOX? Well, in 2012, Protiviti conducted a SOX survey, and the results of that survey showed that the next evolution for SOX is automation and optimization of controls. 41% of the companies responding to that survey indicated that they were moving more controls from manual to automated. This hasn't changed in the last year or so. And a lot of the companies that were polled were aiming to try and get 20% increase in automated controls. And this still holds true today. The reason for that is once you do get it automated, it becomes less of a manual process. You can have the system accumulating the evidence for you that it's been executed. You can improve your process as you eliminate a lot of manual steps, which we'll walk through an example later on. But most companies in their rush to the IPO and implementing their SOX program rely on manual controls simply because They're easier to implement. They're pretty straightforward. You're going to do this, somebody else is going to review it, and somebody's going to save that evidence for later testing. You don't require IT assistance to implement manual controls. You rely less on systems and reports in the manual controls, and you do more of the process manually. But this drives up the cost of the underlying processes and the testing work. So automation is a good initiative. But automation takes careful thought as to how the control should be operated and how that control should be documented so that it can be proven that it is working properly. So we're going to talk now about how these could be achieved through some of the cloud solutions that exist today.
Yeah, thanks, Dave. Great segue into where we're going. So we really have, I think, a couple things. One is just the overall infrastructure of what's happening. And what you're doing is everything that is inside of the cloud, if you will, is offshored, if you will, to your service provider. So kind of think about some of the service providers that are out in the market today where people are leveraging solutions to solve their products. So it might be an ERP solution with an approval process around employee time that's been data entered. Another product might be something along the lines of document signing or contract signing with either an EchoSign or DocuSign type product where you're having electronic signatures that are going through. So instead of having a workflow where there is a wet signature or ink signature, there's an electronic signature, and automatically once the documents are signed, it sends it to the next step to initiate invoicing or approve a purchase order or some level along those lines. We're really seeing that entire process just move right outside of the environment or on-premise solutions and right into the cloud. And we're seeing them integrated really nice. But that whole infrastructure, from the application to the platform and the infrastructure that's needed to maintain and support that product, is really provided by a service provider. So what we're seeing is clients are logging in from all sorts of devices. So for many years we've heard about the concept of bring your own device. It's really at our doorsteps now. We have clients that are working with iPads or some level of a notebook type concept or tablet. Their phones, they're getting dashboards and information and approving transactions on their phones while they're waiting for the train or something along those lines. We're really seeing that whole automation and leveraging the technology that comes into play by these different tools, and it's making a very mobile workforce. But the benefit of it is it's also increasing our internal controls because it has to go through the process of, the computer either knows is a checkbox checked, yes or no, and if it's no, we put it in a holding pattern until approved, or if it's checked, it's yes, then it could go on to the next step. So it really helps to increase that whole internal control process that comes into play. So we're seeing that really built around those three pieces.
Now, Scott, for decades, companies have been outsourcing payroll. Last couple years, probably 5 years now, people have been outsourcing expense reporting. This is just an extension of those services that have been provided in certain unique areas for decades.
Yeah, the concept is not new. I think the payroll providers were one of the first ones to really bring that to fruition, and maybe even banking for personal banking. I remember, through the old dial-up. I'm going to date myself and age myself very quickly, but I remember the first time being able to dial up to my bank and get my bank account and see what was cleared through, and it was a program I had to install on my desktop computer. dial in to call into the bank. It would hang up and call me back and then download my information so I could see under the application that came through. That concept has just been automated to go through the cloud or the internet versus online, and it's real interesting. Speaking of banking and payroll type things, some of our most confidential information that we have, at least as individuals, is our personal banking or banking accounts related to payroll, our social security numbers, our company's tax ID information. All of that's been out there for many, many years. And so the infrastructure that's been built around the security, and we'll talk about this in a little bit, is pretty robust in terms of having that be their full-time job, is to make sure that that's secure. I think individual companies will struggle in that area, and I'll touch on that in a little bit as we go forward.
Okay, thank you.
All right, so the Cloud Accounting Institute does a survey every year, and they talk about cloud accounting, if you will. And so I have two surveys. One's the 2012 and then the 2013 one, which is the most recent one we'll talk about in a minute. But I'm talking about the 2012 because I want to show a little bit of the shift in terms of what people are really concerned about. A few years ago, every conversation that we started with, people were just apprehensive about going out and putting something onto the cloud, just altogether. So, that whole thought process and having to go through and educate the individuals of where is the technology going and why should they be able to rely on it and have these issues resolved. So this is a kind of a good area where we've spent a lot of time over the years talking to people. It's really around application performance. So, it's not uncommon for someone to say, well, I have a hard time even getting into my dial-up solution or my existing solution that I have today. How do I maintain that system or have belief that the cloud can do it better? Or security concerns. I'm concerned about my data being out there and someone might be able to steal it or take that away, or even just be able to have access to my data. And then even down below, which is not unique to cloud accounting, but integration challenges. I think that's been involved with ERP packages for many, many years, or IT solutions, just getting it to integrate in. So that's something that has been there for on-premise or cloud-related activity, and we'll talk about a couple of those things as we go forward. But if we look at the 2013 survey on the next slide, we'll see a little bit of some of the shift. So instead of it's now looking at the overall concept around security as being the number one topic people want to talk about, of just how do I make sure my data is safe, that I'll have access to it, I'll be able to use it, and so on and so forth. And then what's dropping down below is the concept around some integration challenges. And I'll talk about why I think that's changing or shifting in the market. And then the last piece that's up there is really around the total cost concerns around that, and I'll talk about all three of those here over the next couple slides. Oh, we have a polling question. More CPE requirements.
All right, polling question number 3. What process controls can be automated by implementing a purchase requisition tool? Is it order to cash, corporate governance, procure to pay, financial reporting, or treasury? All right, give you a couple more seconds to respond.
We've got 80% have participated, so remember you need to get your CPE, you need to at least respond whether it's right or wrong.
Exactly. All right, we've hit 90%. Thank you very much. We're going to go ahead and close the polls and take a look at the responses.
All right, so we have the majority of people, 87%, voted the procure to pay, which is really what that is. So it's a purchase requisition is part of the purchasing process, or the procure to pay process that comes into play. All right, so we're going to talk a little bit around security as being one of the company's biggest areas of concern, and breaking it down into a couple different areas. There's application availability, so just having access to the system. We'll also talk about the application security, so user access, roles, and permissions that would come into play. The system integrity of that, and really, are there good processes and procedures around the maintenance of the service provider that's providing that? And then data redundancy, or really, in my mind, having that ability to quickly resolve some level of disaster recovery, and being able to get access to your data should you want to or wish to migrate to a new solution if need be. But really focusing in around the application availability that comes into play. That's where you'll hear about the 4 nines or 6 nines and 99.99% uptime being quoted by the companies. And what you really have to do to identify what does that mean is understand their calculation. So uptime means available uptime in most cases, and what available means could be different by each service provider. The level of maintenance, when they will do their upgrades or system maintenance that will come in, and how frequent will that happen. In a lot of cases, they'll take that time out because that's what they're considering just their normal downtime to come into play. So uptime, get an understanding of what that means and how does that really get calculated. The other piece of it is ask about the major disaster plans. Where are their data centers? Who maintains them? Where are they at? What are the plans to get them back up and going? And most importantly, what is their policy or guidelines or SLA, service level agreement, around how quickly can they get you back up and going should a data center go down? It is not uncommon. Even some of the biggest data centers have had, believe it or not, fires where it shut their servers down, and it did take some time, not a lengthy period of time, but it did take some time to transition all that data over to a new data center or to their alternate data center. So just get that understanding of what does that mean and where does it go. So that's understand their scheduled maintenance time, making sure that that's convenient and meaningful to you as an organization. You don't want that to be in the middle of your quarterly reporting. I think it's an important call out. Some companies have off-scheduled quarter reporting, and you need to make sure that scheduled maintenance won't have an impact on that.
So Scott, question around, can a company, especially smaller or emerging growth companies, can they afford to put together the types of infrastructure for their systems that the cloud solution providers have?
Usually not. It's a real interesting concept that we'll play into, and I talk about it as the iceberg concept of where's the cost. Is it below the water or above the water? And I'll talk about a nice concept of how that comes in together. But that really plays well in terms of in terms of the world-class effort. Can a company afford to do this? Probably not, and probably they don't want the distraction of time and from the executive team. They want to execute their business plan and move forward. But application security, that's the same with your on-premise solution that you have today. It's your users, roles, permissions, how you're granting them, being able to maintain it, being able to get the data out as to what users assigned to what role within the system, and have some level of a review process around that. That's very similar to your on-prem solutions that you have today. The one thing that will come into play, though, with your auditors will really come into play with the SOC Type 1 and Type 2 audits. Very, very common for all these cloud providers to have that level of documentation and be able to provide that over to you for your auditors to review as well, and that they can get comfortable around that. I'd say just about everyone has one. In fact, I haven't seen one not have one in play. The other is, PCI compliant, making sure that your system, if you're capturing credit card information, that you have that data. And then a new one coming on board that is not listed up here, but is one that we should at least talk about and be aware is going to be around HIPAA and making sure that the HIPAA compliance is taken in place. And in most cases, we don't see HIPAA-related information in their ERP, but there's some areas where it can get exposed. So self-funded insurance programs could wind up with some HIPAA information in their AP process. I've run into that type of an environment, as well as medical practices giving refunds to customers. So they might have a front-end billing, medical billing solution that's processing that, and they may have, a lot of those systems, believe it or not, don't have a refund or reimbursement program out of that, but it has the ability to export information out to an ERP solution. So now we're getting some customer information or patient information, if you will, into the AP process. So we have to be careful around those two areas for some HIPAA things, or the common ones that are at risk that I could see.
That's great. Thank you.
And then if we go back to the one last slide, the last piece of it is really around data redundancy and backup, and making sure that there's a disaster recovery plan, not only from a standpoint of, hey, can I just get a full backup of all my data, but geez, I just posted this entry into the system and I want to roll it back for 5 minutes ago, and not have to worry about undoing what I just did, or accidentally deleted all of my setup type things that can happen accidentally with someone that went into an area they shouldn't have, didn't have the security permission set up right, but was able to do something devastating. You want that ability to roll back right away. A common thing that I see companies not asking about on some of these service providers is who owns the data and how do you get access, or how do you maintain that system when you're done using it. And there could be the reason why you're done using it for many reasons. A lot of clients that have the aspirations of being a public company, they will make that march and go down that road, and they may actually make it out as a public company. But in a lot of cases, we could see them getting into an acquisition type concept. And so as part of that acquisition, you may want your data for what I'll call archival reasons, or for the ability to go back and access it for some level of audit, tax compliance, or some level of inquiry. You'll want to have access to that, but maybe not have to pay full fees or full fare for it, or have that ability to easily extract it into something that you would be able to go back and reference that data. So those are some questions to make sure you're getting comfortable around that area, around the security piece of it. Go ahead. And then, just overall, this is an example of what we've seen kind of come into play around clients' activity. And this would be a fully integrated type solution that's coming into play. So, for example, in this case, it's all being built around an intact ERP solution. It's being coupled with adaptive planning for a budgeting concept. There's a Coupa integration over on the right related to procurement, along with expense reporting that could come into play. There's a keyed-in solution really around managing this customer's projects or deployment of their solution. Salesforce, deploying their customers, managing their acceptance of contracts with their customers, and having a workflow with that. Bringing in a subscription billing type solution, so a recurring piece of it. So kind of thinking of the needs of all these systems of having a best-in-class a solution around projects for keyed in, You set the customer up on the solution, which then generates some level of recurring billing, and you're utilizing the Zora solution, but also tying in the BI or like a click view concept to be able to get really the business intelligence that you need out of that solution. And so the real concept around the integration is that you could have multiple systems together and bring it in all as one piece of it, and for different reasons. And this kind of architecture is going to look a little different for each client.
And is that one of the inherent advantages of the cloud, in that you can pick and choose best of breed people that are focused on solving a solution in a narrower sense than trying to be everything to everybody?
Yeah, so this best of breed concept is really around integrating solutions that are very narrow in what they provide. So for example, the Coupa solution really narrowing down on procurement process and the approval process around making purchasing decisions, or even the expense reporting within Coupa. Very narrow solution that comes into play. So it's really around managing PO, the buying process, if you will. It's not going to go out and do your financial reporting. It's not designed for that. That's not what their aspiration is. It's going to integrate, and it's designed to integrate with an ERP package. And the ERP pieces that come into play are, for a generic phrase, would be API. And that's really being able to kind of just the concept underneath that is you will have tools that allow automation in importing data is really what happens. And you'll see that these cloud-based tools have a concept of easily deploying this connectivity of importing and exporting the data. And the concept that comes into play is when you import in data using these tools that are provided by the solution, it does the same as if you were to be doing data entry or key punching. Then in the mass majority of it, there's the data validation. I can't import in a customer that doesn't exist or a vendor that doesn't exist in the system. So it helps maintain that internal controls, and it makes the heavy lifting a lot easier that we used to have to deal with when we just put data into a database, into a SQL database. You could put anything into it, but if you didn't go through the proper protocol and the validation, you could end up with some goofy data if you circumvent that. So it's designed for you to go through this process. There's really not another way to go about it. You have to go through and use that. So your control around integration becomes much higher, and the results are much more satisfying. Good. All right, so our iceberg concept, when we talk about total cost of ownership and what comes into play, cloud. So let's talk about cloud and how they price their product. It is really around an annual subscription versus a one-time purchase. So when you look at a product that you are paying for on a subscription type basis, you're paying one vendor a little bit higher. And the way that I personally can relate to this is my phone bill and cable bill and internet bill. Years ago, I had 3 bills. Today, I have one large bill that comes into play. But I'm not paying any more than what I was. I actually think I'm getting some bundled pricing, if you will, because of that. It's the same concept with the cloud. And so it's not just the software that's coming in for what we would think of as a licensing concept. So kind of comparing that to the on-prem, it's not a license-to-license type comparison that has to come into play. It is really the rest of the infrastructure. It's the server. It's the IT resources. It's the upgrades that you'd have to deploy and the testing and the training that would have to be done on that end of it. And to be able to really set up an internal infrastructure and have the same caliber as a cloud, meaning that it's deployed via the internet and it's the security level, there's going to be a lot of funds that are going to have to be paid to make that come into play. I've seen a lot of customers go through a process as they're evaluating new solutions and do a total cost of ownership and compare on-premise to cloud solutions. And when you really take that cost that comes into play, and maybe not even at the same level of security that can be set up by the cloud provider, but something that's reasonable for the company to set up, it still doesn't come out to the same cost level of a cloud. It's typically more. It's a rare case that I see that it comes out to be a lower cost. And the reason for that is that cloud infrastructure is getting spread out over many clients. And so we're seeing that cost be a little bit lower. It's definitely not for free. It does look scary because it's a bigger number than what any of us have seen from a software solution, but it is not to that level. When you really take that total cost of ownership and go through that, we'll see that it pencils out in most cases.
That's great. Thank you, Scott. So now let's just jump in for an example. We've been talking about earlier procure-to-pay cycle, and here's a flow chart depicting a non-optimized one where we manually prepare purchase requisitions, probably track them on a spreadsheet so that we know where they are and who's got them and who's approving it. So somebody puts their wet signature on this piece of paper, and you got an approved purchase requisition. So now somebody creates a manual purchase order and updates the spreadsheet, and then the purchase order is sent to the vendor, maybe by email, but they may still stuff it in an envelope and mail it. Believe it or not, there's still companies that do that. And then the goods are received, and somebody's got a receiving document that sometimes gets lost, but they'll enter a receiving transaction in their ERP system potentially, and then they'll send that document to AP. It's usually via SneakerNet. And then you get the vendor invoice. Now they got to manually match it up to the purchase order, which was approved, and the receiving document, which has some signature on it. And then you can enter the invoice and go through the payment cycle. So that's the non-optimized view. If you go to the next page, where if you were to deploy something like a Intact and Coupa solution, you'd have automated online purchase requisitions. They go through workflow after they're created. They approve it online. They can do it from their iPad. They can do it from their desktop. Send that through to, it creates the purchase order automatically because the vendors are already in the system. Now that you've got the approval, purchase order gets sent automatically to the vendor, so no human intervention there. And the system is keeping track of all this. There's records in there. There's date stamps, time stamps. So you've got the evidence you can produce on that the approval process worked properly. You've got it set up with the workflows that you can show your auditors. This is who gets this level of purchase dollars goes to this person. This type of purchase goes to this person. There's no other way to do it. Because it's hard-coded into this or in a table in the system. The goods are received. You get a receiving document. They enter that. Again, the workflow kicks off to push that into the holding section of the purchase, the payable system. You get the vendor invoice. You just input it. It matches it up to the receiving document and the original purchase order, and if they all agree that that criteria is specified in the system, maybe they're within $1 or $2 or even $10, it just automatically pushes it through the system, creates the voucher in the system, and it moves along to the payment cycle. So all of that is automated. You have much less human interaction. You have documentation of it that's guaranteed to be available. You can even have that documentation sent off to files automatically so that when the sample tests come, I want to see the transaction flow for these transactions, you can just get that information out of the system very easily. So there's the advantage of optimization, and that's what you get a much smoother and cost-effective solution.
So Dave, I think which we'll talk about on our next slide is really around, okay, so where's the evidence, right? And so that's in this example, this is a screenshot from an in-tax system where it really shows the audit log of what's been changed. And so you can go in and look at the different objects that come into play, not only from a type but from the specific transaction, and then what type of activity was done. So you can see right before the access time, there's the action. These were added or edited or deleted type activities, or just any changes that come into play. So there's audit logs. There's also access logs. So just who has access into the system, who has been in the system, and for how long were they in the system. The interesting piece is, on this case, is around a logout type of it being expired or just inactive in the system. I think that's an important piece of just being able to display or show who has had even been into the system.
Yeah. Now this is good audit evidence.
Right. And then getting into transactions, since we're talking about some purchasing activity, of just looking at the history of what's happened to those transactions. So in the upper left side hand of the display, we have a PO receiver, and you could see how it was built if you go down into the history, where it started off as a purchase requisition. It went into a purchase order. It went into a PO receiver, and then ultimately into a AP invoice, and getting that whole conversion process from start to finish, but showing the trail and the life of something from a purchase requisition that comes into play. And you should be able to see this type of activity on both sides of what is the life cycle of an action. So if you look at the history from an invoice and look at it starting in this case, as a sales order, and that it's getting converted into a shipping document, and from the shipping document into an invoice, you can see how all that comes through from that. And then also down at the bottom, looking at just purchasing documents and how those come through with the different approval levels and who approved it and when, and having that stamp so you can do 100% confirmation of that those transactions were approved in the system.
And this sure beats people signing a piece of paper and losing it.
Well, or interpreting what the signature was. Was that really the person's signature, or was it someone else's? If you can't read it, it doesn't count.
Very good point.
All right, and then just again, a more detail around a individual transaction and the history that could come into play from that.
I love the way that has the trail from one type of transaction to the other. That's great stuff.
Yeah. All right, so bringing it all together, and then we're going to end with make sure you stay for the last polling question. You do need to have that polling question, so we're going to wrap it up and bring us all together for one final question. But just really looking at it all from a optimization standpoint of SOX compliance, and particularly relating it to the cloud and the cloud technology. It's here to stay. It's the direction people are moving into in the cloud. There are great products that are out there that will really help companies automate it, maintain their control in place, be cost effective for them, and it's the wave of the future of what we see coming forward. And it started many years ago back at the banking and payroll process as the leaders of bringing that forward, but it's really coming forward to our business processes today. And our polling question.
All right, so this will be our final polling question to wrap up. In just a second, you're going to see it on your screen. So what % of your accounting system infrastructure is cloud-based? Is it less than 25%, 26 to 50%, 51 to 75%, 76 to 100%, or are you not sure? So please take a minute to submit your response, and then we're going to wrap it up. And just a reminder, the recording and a PDF of the slides will be posted on our AMLP website within 3 business days. All right, so I think we're going to go ahead and close the poll, and we're going to take a look at the results.
Yeah, so we have about 21% that have 75 or more or greater percent is in the cloud, and it's really a sign of the remaining portion of the group. It's really starting to come on now, and I think over the years, if we go forward, we'll look at this percentage and we'll see it go flip-flop, where we'll see closer towards the 75 to 80% or have in the cloud, and the remaining portion not in the cloud. I think that's the direction that we'll end up at.
I agree with that from what I've seen.
All right. So just in conclusion, we've covered the history of the SOX, and the evolution of it. A little bit about cloud computing and how that can help you leverage that in your business processes today.
All right, and unfortunately we ran out of time. We do not have time for questions, but what I'm going to do is we've got Scott and Dave's contact information on this slide right there in front of you. So if you have any questions, feel free to go ahead and send them an email or give them a phone call. And we just want to thank you very much for joining us today, and hope you enjoy the rest of your day. Thank you.